ladies and gentlemen. Thank you for joining us on such an interesting market day. Not what we're going to be talking about at this moment. We have Mark Elenowitz, co-founder of Upstream and Horizon Media, I think, if I got that correct. Mark, how are you doing today?
Great. Great to have you. Great to have me, rather. Thank you for
Yeah.
having me today.
Yeah, it's okay. We're at home.
One
We're
of
a
those
shared home.
days.
Yes, no, I totally understand. So let's kind of jump in. Tell us a little bit about your background and how we got to the conversation today.
Yeah. Again, my name is Mark Elenowitz. I'm the co-founder of Horizon and Upstream. And I actually come from a little different background than probably a lot of the other people that you have in the blockchain and the NFT and the whole crypto space. I'm actually a Wall Street banker. I've been on the street now for about 30 years. And I created the methodology for something called Title IV of the Jobs Act, which was Reg A plus, to look, act, and feel like a traditional IPO and to trade on the New York Stock Exchange and NASDAQ. So I'm not sure how familiar you are with the Jobs Act, but Jobs Act was created back in 2012 as a great way to create fat capital formation and allow entrepreneurs to be able to raise money from US investors that are not accredited. And what I mean by that, most investments traditionally before the Jobs Act, you had to be an accredited investor, meaning a $200,000 income or $1 million net worth. And what Reg A changed was the ability now for fans to be able to, that had a large customer base, affinity group, or just a passion for a particular product, be able to invest in that company and be able to be non-accredited just as long as you're over 18. And you would have the ability to now be able to buy in and participate in these offerings. The key, though, the problem at the time was that these asset classes were deemed to be non-tradable. It was really just early design was that you could buy, you could participate, but there was no real exit strategy. So I came along and we created the ability for this concept to what I call bringing back the small cap IPO to be able to actually trade in a national securities market. So we did the first, took me 2 years to convince the New York, but they finally bit into my idea. They thought I was crazy, but that it was supposed to be just these flying cars and nonsense companies. But we ended up doing the first, in fact, the only two on the NASDAQ and I'm in the New York and several on the NASDAQ. So it kind of paved the way for the future of fan engagement IPOs.
Well, the Bear family will know that we're huge fans of this type of idea, Mark. We feel that there's a huge amount of boundary that's put in place between the average participant and the potential upside, especially for recognizing a company earlier. We've often made assessments like, why can you not have a monthly subscription to micro ownership within a company? I mean, if you can pay for the service, why can't you pay to own part of that service along the process? Can you tell us a little bit more about this space as well? Because our interest has been what allows the most people to participate, which is why we like crypto. And I'm not a U.S. citizen. I don't have a whole lot of familiarity with the background other than these types of crowdfunding types of venture capital we're big fans of because of that alignment in concept. Can you go a little bit deeper into what kind of difference this makes?
Absolutely. So let me first start off by saying if you have any DeFi listeners that are listening today, you're going to hate me because I'm the complete opposite of DeFi. So what I mean by that is a lot of the groups out there believe that technology replaces regulation, where I'm of the belief that technology enhances regulation. So the one thing that I think there's been a disconnect is that when you're selling ownership in any type of business, that ownership needs to fall under a bucket of either being what's called an exempt security or a registered security. There's something here in the US called the Howey test. And basically, if you're getting an ownership or getting a return on your investment or a dividend or a royalty, all of those are deemed securities. And kind of to finish my story, which ties back into your question, is when we saw this whole emergence of the crypto space, the ICO space, the security token space, the NFT, whatever acronym you want to use. The reality is that a lot of these come down to is you want to have an ownership. And as you just mentioned, let's say you were a part of the streaming service, why can't you have a piece of ownership in that particular activity? You're already supporting it, you're listening to the music, you're paying subscription fees. Why can't you get the benefit of return? The benefit of return falls into the securities category. So securities in the US need to be, as I mentioned, either registered or exempt. Registered would be like a straight IPO going onto the New York Stock Exchange. You file with the SEC, you have investor disclosure, and it takes a process, and an underwriter will come in and then bring you onto the New York or NASDAQ. Reg A Plus was a lighter form of registration, or quasi registration, actually falls as an exemption, where you still have disclosure, it has investor protections. And that's the key, because a lot of these investments, the investors need to be able to make informed decisions and be able to get both the positives, but also the negatives, so they can determine if this is going to work for them in a risk factor. But now we have this whole new world of crypto that comes up, where you have a DeFi community where a global audience wants to be able to come in and buy and not have to worry about these regulations. And while that seems great on the surface, the reality is there's a lot of danger, because most people like to have are good natured and they want to do the right thing, and they actually believe in their business. They've written a white paper. They think that with a proper amount of funding, they'll be able to succeed. And why not have the community support them and give them capital in order to fulfill their dreams? But there's others out there that don't have that attitude, that are scamsters and that are going to do rug pulls. And we've seen it over the last year. So what there's needs to be determined is, how do you sell a security to a community in the DeFi world where you comply with not only that investment or disclosure, but also other important features like KYC and AML. And what that means in plain English is know your customer and anti-money laundering. You don't want to get mixed up by selling securities to people that you have no idea who they are, who might be on a terrorism watch list, or who, unfortunately now with what's going on in the Ukraine and Russia, where we're seeing actual sanctions violations and manipulation that way. So it's a key to how do we make it both work. The US took a very positive stance with Reg A Plus. The DeFi community has taken an amazing stance by creating these new mechanisms in order to fund. And there's a balance between the two. And that's what we do at Upstream, where we've created an actual regulated stock exchange. It's the only national securities exchange powered by the blockchain. So we integrate investor protections, we integrate the ability for investors to have informed decisions, to be able to read a prospectus. But at the same time, we allow the crypto community to be able to come in and use USDC stablecoin as the ability then to buy into these traditional asset classes. So it's really exciting, because we take a non-traditional asset class like ETH or Bitcoin, use Uniswap, convert it into a stablecoin, and now buy US equities.
So part of my, my sentiment here is not that regulation isn't somewhat potentially positive, again, because it has positive benefits. But one of my thoughts here is always against the least amount of regulation possible, because no matter who you are, if you're a new investor, you're going to come in, you're going to do the same thing that every investor will do wrong along the way. And there's really no guardrail for that, regardless if it's a scam or not. You're going to buy something at the top and you're going to sell it at the absolute bottom. The investor education, I think, would be a much more important accolade than regulation. Do you feel that regulation allows the consumer to participate? For instance, part of my sentiment here too is, okay, well, under this idea, a Rolex is very easily a security. I mean, people buy Rolexes all the time, knowing that these are going to go up in price. Philippe Patek, there's clearly many other instances in which products that go up in value that have open market value outside of that ecosystem are being traded and sold at, again, knowingly marked up prices too. We know the luxury design space does this on purpose. They limit the amount that they use scarcity the same way a digital NFT collection would. How do you feel that the argument for these not being products the same as Rolexes take place? Or are we going to just define a Rolex as a security because people speculate knowing that the price is going to go up due to the scarcity model?
No, so I mean, that's one of the interesting topics. It's the SEC has telegraphed, and the Treasury Department has telegraphed here in the US that they're going to be enforcing against marketplaces and individuals and issuers that are dealing with assets that are deemed to be securities. The question is, what defines a security? And it's a fine line. Is that Rolex or a baseball card or a piece of art a security, or is it a collectible? I think I would argue the point that it's a collectible. If you have a fractionalized ownership where more than one person can own that Rolex, where you could create a special purpose vehicle where now 1,000 people who couldn't afford an $8,000, now some of them are going for even more, Rolex, and now you each own a slice or a sliver, there's no doubt that that's a security. And that is what needs to fall under securities laws, because that's where investor protections need to be put into place to make sure that everybody understands who owns it, how does it get paid, what happens when that Rolex is sold, how does everybody get their proportionate ownership. If you're dealing with one where you're trading, but the real issue, and it's still yet to be defined, and this is something that I think we're going to see over the next several months to years, is the asset itself the security or not? If an NFT is utility and function, and by the way, we take the position, many of the NFTs that we work with on Upstream, we work with celebrities and musicians and entertainers and athletes and movie studios and the NBA G League and other types where we're using NFTs as a utility function with no economic value that would be deemed a security. They're purely collectibles for the purpose of utility or fan engagement. But when you cross over and you look at the marketplace that these security or these NFTs are being sold, do they need to be regulated? So if we removed the buyer for a moment and looked at the venue, does the venue take the proper precautions to ensure that it's a fair and orderly marketplace, that investors who are buying these collectibles, buying those Rolexes, buying those NFTs are able to compete or bid against each other in a fair environment and know that they're protected, that no one's going to hack them or steal their money, or knowing that they're not going to be dealing with somebody who's on a nefarious bad actors list. So I think ultimately, I believe, in my opinion, that we're going to see regulation enforce against the marketplaces, not necessarily against the creators, unless that creator clearly violates and becomes, like I give you a classic example. There's a misconception out there that royalties attached to music are okay. If you own a piece of a song and so does 1,000 other people, and you clip a royalty off the music that's played, that's a security. So it has to be issued in a proper format. If you own a song and you're the sole owner and that artist created that song and sold it to you, that's not a security. So it's a fine line that needs to be really examined. But to go back to your question, you said, what happens, because typically investors buy high and sell low. The whole concept of the market is buy low, sell high. Unfortunately, all of us seem to be making that mistake lately, especially today with the market off again. But if you think about from an educational standpoint, that's market timing. Is it really that the investors are making informed decisions because they don't have the education on how to play the market? Or is it something that's being promoted to them where the buyers have already occurred, and now that the layman or the individual investor is getting in at the end when the rug is being pulled? So the pros have already bought, and it's typical. We saw when Facebook came public, all the institutions were selling and retail were buying. What happened? The stock went down.
Yeah, this is the IPO is basically the grandest of the pump and dumps, is it not? Like it's effectively, hey, all of us who are extraordinarily regulated and can afford these huge power buys, like Uber was a great example of this, where it nowhere near ended up the average participant's ownership. One of the things I've liked about this is vastly different than the model of just buying. You're rewarded for that ownership participation as well, which is something I think that might even break that tie to it being a security. Like if you can get it randomly given to you through a bunch of different outlets of participation, doesn't that not change some of its functionality as well? Like can a token not then become a utility just by the nature of how it's used within an ecosystem?
Yeah, we have already in place. It's called frequent flyer miles. It's a concept that's been around, but then it's what happens to that frequent flyer mile or that NFT or that drop or that asset class that you receive, what happens after the fact. So if you're rewarded for being a participant, if you're rewarded because you're utilizing a universe or a walled garden where you get benefit for watching content. I'll give you an example. Here at Horizon, we built technology for a mobile carrier. The mobile carrier, the more mobile content you watch, the more mobile minutes you receive. So kids were uploading TikTok videos and other types of content to watch because they would get their free mobile minutes. We created the ability to create any of that content into an NFT in 30 seconds. But what we do is then we have those NFTs trade within an ecosphere where you receive more mobile minutes to be able to continue to have your cellular service. Where it crosses the line is if you can monetize that, take it out there, translate that into a cash component, and then allow others to be able to buy and sell without coming into an ecosphere of KYC and AML, that's where that fine line is crossed. So we still need to see, and again, this is where I said that the DeFi guys hate me, because I think there's a balance between regulation and technology. And we at Upstream create that balance because we allow the experience of a Web3 and full DeFi type non-custodial model, but at the same time with investor protections to make sure what's being sold is actually what's being sold and not something fictitious.
Well, we can go. We'll save some of the other. I had a few other questions. We'll save near the end. So tell us about the build out process of Upstream and Horizon. Give us a little bit of a rundown on the development so far.
Yeah. So as this market evolved here in the United States related to Reg A, we started looking at it, and this whole world of now ICOs and tokens came about. And our regulator, which was FINRA and the SEC, we decided to take a look at it. And what we found was there's deficiencies in KYC and AML and custody and clearing, and you need to have transfer agents. So this whole concept of having real live secondary trading in the US hadn't developed yet. So we were looking at trying to create the ability. And unfortunately, at this point in time, the SEC has made it clear that they're not quite ready to adopt the blockchain yet as a source of truth. Although we all believe in the blockchain world that it's immutable and transparent and all the great things that blockchain brings, it's hard to take what's been done for all these years here in the US capital markets to accept that there's this new ledger that it exists. So the SEC has put out that there are certain criteria that you can follow where you can have your own marketplace known as an ATS to allow the secondary trading of these assets. But unfortunately, it doesn't happen in real-time nature where a broker-dealer can actually be involved and facilitate those trading. So what ended up happening with us is we decided to go offshore, and we partnered with an exchange called Merge, MERJ, which is the National Securities Exchange for the government of the Seychelles. And we teamed up to create this first global exchange that's purely powered by the blockchain, where it's an app-based marketplace where investors can come in, download an app, go through KYC and AML, open an account. They're actually opening a bank account where we offer investors insured accounts for $250,000 of FDIC insurance. We allow investors to use cash, credit, debit cards, PayPal, and we do allow cryptocurrency in the form of the USDC stablecoin, and allow them to come in and then see offerings made by prospectus where they can make informed decisions. And that came live this past December. And since that time, we've gotten really excited because what we started focusing on then was this new shiny penny that everybody was chasing, which was called an NFT. And when we looked at NFTs, we got very excited about it because we recognized that this was the future of just all aspects of fan engagement, collectibles, being able to use as in-game currency, and all the benefits that I think everybody and your listeners understand related to that market. But what we've decided to focus on was, rather than going the OpenSea model or the collectibles model where everyone's trying to sell these very expensive NFTs, what we focused on was back to our roots of fan engagement and being able to have a fan connect directly to a celebrity or issuer or entertainer. And we designed the ability for fans to own $25 NFTs, where these NFTs were designed for the 99% of the world that have no understanding what an NFT is, what ETH is, what MetaMask, or all the other steps. With our marketplace, an investor can come in, or a fan can come in and get their favorite athlete, celebrity, entertainer. And for $25 or even for free, because we give away free NFTs for these events, it can come in and you, with a tap of a button, use their credit card or PayPal, and a few seconds later, they own an NFT without having to go take dollars, converting to ETH, and using MetaMask. It's designed to be a simplistic model where you can not understand that what we did behind the scenes was actually creating a wallet for you, signing it to the blockchain, and doing all the things that were necessary to have a full Web3 experience where that NFT can transition from our marketplace to any other metaverse out there.
So one of the next parts here I wanted to check into is around again, these kind of participation rewards. One of the things I find so fascinating about this sector is that nowhere in any other product history model do you have products giving out basically large sums of money because of the interest of the growth of the sector. So because the participant, the average person, it has almost pretty much every single step of the way been blocked out of participating in the early growth of things like Facebook. This is why I call them, they're basically the regulated pump and dumps, is because you have so much back end investing, and the average person, unless they got lucky, like super lucky, basically by knowing how to like have a few friends and have an extra 5 to 6 figures to drop in somewhere, they really didn't get to participate in any of the tech boom. What I've liked about this market, and this is kind of just a more of a philosophical question, is that you have a large amount of participants in the world that have no identity or bank account or access to financial services at all. And where companies like MasterCard and bank accounts have totally lacked in the ability to proliferate, we see this huge proliferation of the tech in places like Philippines and Venezuela, where it's of an absolute necessity to have something that again is more stable than the dollar. And what's interesting here is that in these countries, the data minutes that you mentioned are actually used as money, because it's more reliable that the data is going to be consumed at a certain pace next to the money. So part of my question is, do you feel that the United States regulation will hold itself back right now, and other countries that are lesser in that regulation are just going to basically boom ahead without I guess, some of the problems of bureaucracy getting in the way of who's even allowed to participate?
Yeah, there's no doubt that that's going to happen, in my opinion. But we've also seen that the U.S. has taken some pretty solid steps forward with leveling the playing field and allowing investors early access to these opportunities. That's what the Jobs Act created. There were three main components. There was Title II, which was general solicitation of private placements. It used to be like your example of the early it's not what you know, it's who you know. The rich get richer. It was for these accredited investors that were in this country club community where they would always get access, pass the hat, and get the best opportunities, where the little guy never got a chance. That changed with private placement solicitation, where you could actually put up an ad in the Wall Street Journal or a billboard in Times Square and advertise it, but you still had to be accredited. You still had to be in that 1% of the elite, the $1 million net worth. So that's not realistic. Then we had something called Title II or Title III, excuse me, which was Reg CF, which is crowdfunding. And it used to be you could raise $1 million, now it's $5 million. Problem is you can only raise the money on that website, and you can't trade the securities for 12 months. There's a statutory hold. So the US government, through the Jobs Act, Title IV, and the SEC adopted it, was that now non-accredited investors could buy up to 75 million, have immediate liquidity if there was a marketplace for them to trade. So it was a good first step. But as you said, the rest of the world has recognized now the transition into the blockchain to allow the unbanked of the world to be able to participate. And I think that is an amazing step forward, because there are countries and investors around the world that want to get access. They want to have the ability to have their time, whether it's $100,000 if they could afford it, which the majority of the people probably couldn't. But why can't they buy $10? And we're doing that. We have an offering coming out on our exchange to the Indian community, to the Bollywood community. We're working with one of the major Bollywood movie producers and studios, where we're taking 1,600 of their top songs. So you listen to the music. This is an ability to finally get paid back for you've supported this particular singer or that particular soundtrack. You've listened to it. You've watched the movie. Why not get paid for it? And now you can actually get participation in those royalties for as little as $10. That's the democratization of using the technology to democratize investments. But I still said this before, you have to have guardrails and regulation in place to make sure that if you're making those payments, that it's done through a regulated manner so all those people can have it. You do need to make sure that you're dealing with people in the right community. You mentioned Venezuela, and that, although that particular country needs and is utilizing cryptocurrency in order to stabilize and be able to move funds around, the problem is they're on our sanctions list. So in the US, we can't deal with them. That's a violation. It's a dangerous area to be in. And there's other countries like Iran and North Korea, and now obviously what's happening with the Russian sanctions. So it's this balance, because in one aspect, government's telling you you can't deal with it. And the other aspect is that you have a whole bunch of innocent citizens that want to get access, but you're barred as regulated people or just general populations here in the US and other jurisdictions where you can't do business with these bad actor lists. And unfortunately, a lot of these people are put on them.
Yeah, there's a few different rabbit holes around informed anything we could get into, but I wanted to stay here in this regulatory topic just because I think it's kind of a fun area to have a little bit of contention. Um, for any of us that's been around for a long time, EOS was, I think, a very notable point in first off the way they sold their token, how much they raised, because it was a ridiculous, probably one of the biggest fundraisers in history or something like this, at least on an open market. And they were able to get away with just a slap on the wrist. Do you feel that the SEC is currently worthy of like the praise of the regulation that they've currently like brought to precedent? Like, hey, just as long as you can pay us off seems to be their only memorandum.
Yeah, I know. And that's unfortunately and I talk to people all the time that are looking at doing offerings, and they're asking forgiveness rather than permission. And that's not the way you look at things. And unfortunately, in any type of government agency, they're slow to adopt and they're slow to enforce, but they do have quite a big stick that they can swing. And I think what you're going to find over the next year with Gensler coming in, and this is a very intelligent man who knows the industry, he comes from industry, but he understands securities laws. So I think what you're going to find is more and more litigation is going to occur where the SEC is going to go in. And I think that's going to be a good thing, because there are going to be a lot of companies that are going to shine because they're doing it the right way. And I think the bad actors are going to be weeded out. And when you deal with investors, and a lot of these ones, I would say, the question is, were investors harmed? And it all comes back to retail investors. So if retail investors are harmed, then somebody needs to come in and protect them. And then one should say, when people argue, can't these investors protect themselves? And who are we as the government, or we're not the government, but who's the government to come in and protect them if they don't want to be protected? But I think what you will find is that as the SEC starts to get more and more involved, I read an article just last week that they're staffing up another 50 enforcement attorneys. And I think they're going to look at things on a case-by-case basis. And I think they're going to look at, and I believe that ultimately, when you look at regulation as a whole, that those markets tend to prosper once regulation comes in. And if you're a good actor and you play by the rules, then I think everybody wins. But I do believe there'll be some cases where they overstep their bounds. And we're seeing this right now being argued and litigated in the courts, right, with particular cases that the SEC is going after, and there's been pushback. But ultimately, I think at the end, it will be good for all.
Yeah, it's one of this idea of like, I could sign a waiver to jump out of a plane and potentially die, but I can't sign a waiver that just says, I'm willing to invest and lose all my money. And you should have that's what they need, is they need just a simple sign off here. You're allowed to do whatever shit in the investment world that you'd like to do, basically.
Yeah, there's a balance. You're right. I mean, and that's why I'm saying there's got to be a balance. And it's, I could argue both sides of it too. I'm trying to take the middle ground because I think there is a balance where investors should be able to make any decision they want, as long as the information is presented in a fair and balanced manner that they can make an informed decision. No one should tell me that I can't make that investment, but everyone should tell me the pros and cons of it. And I should, as a consumer, know that if I'm buying something and I'm taking that risk, the guy on the other end should deliver, at least do his best to deliver. Not all businesses work, most fail, but at least he's not taking my money and running away and doing something else with it than what he told me he should be using it for.
Well, I'm assured you're preaching to the choir around informed consent here.
Yeah.
I spent a lot of time studying and researching. It's one of my favorite things to do. So that's why I was interested in this potential part of the conversation too, is that these regulators haven't done really a good job of protecting anyone. What they seem to do is find a way to align their pockets almost solely. And as long as you can make enough during that process to pay them off, they seem to not really care. Like I haven't seen
I
any
think
particular
that's
case that jumps out as like, hey, these guys are actually doing good by the investor. And here's and also too, because you have such a high failure rate with a company, anyways, whether it's a scam or like a totally legit person trying to build their dream, regardless of how vetted they are, this 90% chance of failure. Like, why not just have the waiver signs? That's why I said signs off everything. That's what we need. We need new legislation that just allows you to sign off whatever crazy stuff you'd like to do with your money is okay, as long as you sign here.
but that's only half the coin. So the other side of it, that's half the investment thesis. So I don't think regulators are saying that you can't, as an individual, make a decision. That's what Reg A Plus allowed you to do. These markets, you can come in, you don't need to be accredited anymore. It's available to everyone. But what the regulators are saying, which I applaud them for, is that the person that's selling the security has to have adequate disclosure. So me buying the security, whether knowing that I want to do it, I know that that drug is probably not going to ever get approved, but I'm willing to back it because what if it does? It's going to be big. But it's important that the person that's selling me that security is doing it in a compliant manner, and the marketplace that's doing it in a regulated manner. Where because we've seen nightmares too, where you got good issuers, good investors, and the market's a scam, and then the market disappears and takes everybody's money. That's where I think there's that balance by using the blockchain and using the ability for have the crowd be able to support it, but at the same time having the marketplace where everybody comes together and meet, do it in a safe manner where you know you're not going to get scammed. Whether the deal works or not, different story, but at least you know you're safe in this environment.
So can you tell us a little bit? You mentioned this unique type of banking relationship between the company. Can you go a bit further into that?
Of our company.
So yeah, sorry, with Upstream and Horizon.
Yeah. So what we were able to create was, and this is again where I think from our marketplace, what sets us apart was we have a lot of celebrities that are partners of ours and friends of ours and investors of ours, where they came to us and said, we wanted to do something on OpenSea. And when we looked at it, we said, well, hold on a moment. This is a great market. I see that clearly it's one of the biggest marketplaces in the world. But one of the reasons it's such a big marketplace is it's an anonymous marketplace where you don't have any idea who the buyer is. And while that's very appealing because we see a lot of volume, we see a lot of transactions, we also see a lot of manipulation, we see wash trades and all the other things that everybody knows about. But my biggest concern was that you don't know who the source of funds are. So in the US, we have something called the Patriot Act and Bank Secrecy Act. And now we have this whole new thing called the Infrastructure Bill, where when you're selling something, you need to know what the source of funds are from. And one of the things that people like to make arguments to me all the time with when we get into these discussions is, and this goes back to what you're saying, is it a security, is it a utility, is it a collectible? But if you're going to take the argument that it's a piece of art, it's a collectible, there's something that we have here in the US called OFAC. And OFAC put out a notice about a year ago, February, that said that one of the biggest sources of money laundering in the world is art. And you have to know who the counterparty is. You have to know the source of funds and the customer to ensure that you're not violating it. So as a celebrity, if you're dealing in this market and you sell something great and you get $3 million of ETH, how can you stand before your bank here in the US and say that you know that source of funds? And what if it came from somebody in a nefarious country, like I said, unfortunately, Venezuela or Iran or North Korea? You're really putting yourself in harm's way. So that background is why we're so different, because at Upstream, we do a light touch KYC. We're not intrusive. We just want a little bit of information because we want to make sure that you're not on any of these bad actor lists. And that protects our celebrities and our clients, which are large movie studios and very well-known artists and athletes and entertainers and musicians, because what we created the ability to do now was for you as a fan to get close to one of the acts or the stars that you want to engage with. And the idea is that this 99% of the world that has no understanding, if you're at a concert and you're watching your favorite artist, that artist can go on stage, sing a new song, drop a beat, and 30 seconds later, that's an NFT that everybody in the audience can buy who don't have MetaMask accounts or Coinbase accounts, that they hit a button and they own it 30 seconds later using a credit card or debit card. And now they feel connected, and they can go home and they can take that NFT and share that directly with their fans and their friends on their social media, and eventually be able to put that into the metaverse. But they're doing it in a manner where when they open an account with us, they actually have a bank account. So back to your question, is they know that their cash is safe and secure with us, that if the account was hacked, we can replace the NFT. If the account was hacked, the money can be only moved to a third party, to the same name at their traditional bank. And there's FDIC insurance in case we, as the exchange, disappeared, that they're covered for $250,000. And that insurance is something that we as Americans take for granted. But outside the U.S., and I don't know where you are, but most other countries don't have insurance to protect the investor in that manner.
Yeah, see, I'm always one to argue against insurance and aim more for that like broad open waiver here. Like I sign away. I'm jumping out of a plane right now. One of the things I love, Mark, about asymmetry or some of the kind of mathematics behind venture capital, you could call it a philosophy of fractals in mathematics, I think, if you look really closely at it. But you're looking for these really, really like far out moments that the order of magnitude and gain is just so far past whatever you invest. The idea that people are participating, like I had friends buy these Bored Apes for like $2,500, goes up. There's just constant delivery of interesting ideas and capital. I'm really excited about the potential that it's evolved to, I guess, kind of without regulation. It's not that we're staunch against regulation. Ultimately, we think that those things would be great if they're enacted properly. I just so seldomly see that the regulators are doing something actually productive. I see fingerprints of what appears to be some type of regulatory capture. And I'm like, well, this is just still out of the arms of the flavor of most participants. You're right. It's not, they're hard to find insurance down here for many things, depending on what it is. Well, Mark, we're gonna kind of fade out for today's conversation, but tell us a little bit about more we can find out about Upstream and Horizon for all the Bear family that are interested. The links will be down below. I'm not sure I got them in today's video just quite yet, so you might have to come back. Yeah, you want to share that with Vocal?
Yeah, absolutely. So clearly we're never going to see eye to eye, or maybe not in the near term on the regulation side. But listen, on the NFT side, the side of the NFTs that we work with, we would encourage everybody to really look at, because it's not the Bored Apes, it's not these collectibles, it's fan engagement. Wouldn't you like to be able to have, if you went to your original, like my family, when I was a kid, my first concert my parents took me to was the Michael Jackson concert with the Jackson 5. If I had that original ticket sub, like what I would do with that today. That's what we've created the ability with our NFT marketplace to allow you that if you go to your concert of your favorite artist, the ticket itself is the NFT that you will be able to keep for a lifetime. And you're buying it for $25, $100. You're not buying it because you think it's going to go up in value. You're buying it because it's meaningful and it's a reflection of yourself that you want to display into the metaverse in the future. So what we have, and we just recently announced Edgerrin James, NFL Hall of Famer, is part of us. You'll start seeing over the next week on a weekly basis all these celebrities and bands and hip hop bands and entertainers and pop stars and movie studios and all these opportunities to transgress entertainment beyond the theater and the screen or the concert or the event, and be able to transfer that and have a convergence into the metaverse. That's what we built. So it doesn't really matter with regulation. It's all about fan engagement. And you can learn more at upstream.exchange. Our apps are downloadable on all the app stores. We do have the technology that integrates a Web3 experience directly into a Web2 experience, but allows these NFTs to be able to transgress beyond a Web2. We are a full decentralized marketplace where we are a non-custodial model. And the one thing is that we're a layer 2 optimistic rollup. So we don't have any gas fees to our consumers. So when we give away something, if we're giving away 1 million NFTs to an upcoming concert or a celebrity that we work with a couple 100 million followers, it's truly free. And if we use our NFTs as a pay-per-view event, you're only buying the NFT, you're not paying gas. The last thing, and I think you'll probably appreciate this since it seems to be, again, to the DeFi world, we are not one of these groups that buy a carbon credit or plant a nonsense tree or pretend to plant a tree. we are truly carbon neutral. We've been operating since 2017, a solar farm where we mine our ETH using solar energy. And we didn't do it because we thought it was cool or it was going to be something in vogue for environmentally friendly. Our scientists and engineers like to tinker, and they ended up building a really cool product that we were proud of. And we did it for ourselves. But now that it's become in favor, we're letting the world know. So when we do roll up to mainnet, we're using it with solar mined ETH. So it's something that's we're doing good for ourselves and doing good for the environment at the same time, allowing fans to connect. So upstream.exchange, download it, watch for the drops, and hopefully you can be a part of what we're doing.
Awesome. Thanks, Mark. It's great to have you on the show today. Bear Family, another great conversation. We love having this one was fun, Mark. We like opposing views. We try to take that stance. I've been that way my entire life. You kind of come at it so early, often, especially with so many different things, and then you're often battling regulators or even scientific theory to get up to speed with where we actually are in some of these conversations. So it's learned how to have a chip on the shoulder for the way things have been regulated up to this point. One of the reasons I live in Costa Rica is I grow ayahuasca on my property here. Things that you're a little bit more difficult depending on where you are situated.
Pura vida, man. Pura
yeah,
vida.
exactly. Super excited to chat today, so I appreciate that. Bear Family, give us a thumbs up if you like this content. Any thoughts, questions, comments below, leave them down in the comments section. The video will have the links when we're done here. But also, yeah, upstream.exchange, check them out. And Mark, we'll stay in touch. We'd love to see how the development goes and keep us up to date with anything that you guys have interesting coming up. We're fascinated by the way this technology sector is growing and don't think we've even seen just the surface of it yet. So excited to stay in touch.
Thanks for having me.
Awesome. We'll keep you on just for one more second. Ladies and gentlemen, here, look, I actually figured out how to do something fun today. Check this out. Boom.